Here's one thing we can say for sure. Investing in equity markets is not for the faint of heart. Earlier this week, China's stock market endured its biggest one-day drop since 2007, prompting Chinese media to call August 24th Black Monday. In the United States, after an unprecedented 1,000-point decline at the open on Monday, the Dow Jones Industrial Average closed at an 18-month low, dropping nearly 600 points. It's been a rollercoaster ride ever since. Later, we'll talk with two market analysts and a Chinese scholar. But first, to help us understand the recent volatility, we turn to our newsroom and CCTV's Nathan King. And Nathan, some in the Western media are blaming China for the recent market fluctuations. What factors are contributing to the turbulence?
Well, it's interesting that investors are blaming China because we live in this interconnected world. And the presumption is that because it's the number 2 economy, if you see a big plunge in the Chinese stock market, that's bound to affect the rest of the world. But the actual truth is the Chinese stock market isn't even that well connected to the Chinese economy, let alone the global economy. It is trying to get like that, but it's actually built up of a lot of small investors, not big listed companies. They tend to be listed in Hong Kong or elsewhere, including New York. So a 40% drop on the Shanghai index does not reverberate around the world. But the real fear behind that is that there is a slowdown in the Chinese economy and Chinese demand globally. And of course, that can affect the stock markets. Now, Premier Li Keqiang came out and said that the 7% growth target for this year is still intact. We've seen a lot of government moves to try and shore up not just the stock market, but also the economy with an interest rate cut. So even though some Western media and economists have said that China is the cause of this market sell-off around the world, it probably isn't true. It may well have been the catalyst, but as you know, people always trying to hang their hat on a market sell-off. What is interesting about the United States market is it's been on a bull market, i.e. going up and up and up, for the last 6 years, pretty much uninterrupted. And there are, for example, overvalued stocks, especially in the tech sector. So there was a correction, if you like, in the offing. Perhaps China was the catalyst, but not necessarily the cause, Anna.
Nathan, what does all of this mean for governments and for individual investors?
Well, what it means for governments is that the world economy isn't necessarily recovering as everyone expected. The US came out with GDP figures, as we know, 3.7% for the previous quarter. That's good, but not everywhere is great. Europe isn't fantastic. We're seeing a slowdown in China, although very strong growth compared to other countries. So this idea of low interest rates jacking up, for example, in the United States, means perhaps they'll be put off or not rise as quickly as expected. Now, what does that mean for consumers? That means cheap money. It means potential loans out there from the banks as well. So it actually suggests that share prices could rise up because people want to put more money and get more returns than just putting money in the bank. We'll wait and see.
Thanks, Nathan. That's CCTV's Nathan King reporting.
Thank you.